Let's review IB Business Unit 3 on Finance and Accounts. What is the term for money spent to acquire or improve long-term assets like buildings or equipment? Capital expenditure is money spent to acquire or improve long-term assets like buildings or equipment. What is the term for money spent on the day-to-day operations of a business? Revenue expenditure is money spent on the day-to-day operations of a business. What is the term for profit that a business keeps and reinvests rather than distributing to shareholders? Retained profit is profit that a business keeps and reinvests rather than distributing to shareholders. What is the term for raising money by selling unused or underutilized items a company owns? Sale of assets is raising money by selling unused or underutilized company assets. Is the money raised in an IPO called personal funds or share capital? Share capital is money raised by issuing shares in a company. What is money borrowed that must be repaid with interest over time? Loans are borrowed funds that must be repaid with interest over time. What does a bank offer to allow a business to spend more than it has in its bank account? Overdraft is a short-term borrowing facility that lets a business spend more than it has in its bank account. What is the term for buying goods or services now and paying the supplier later? Trade credit is buying goods or services now and paying the supplier later. What is the term for raising small amounts of money from many individuals, typically via the internet? Crowdfunding is raising small amounts of money from many individuals, typically via the internet. How can a business obtain the right to use an asset without owning it outright? Leasing allows a business to obtain the right to use an asset without owning it outright, typically through rental payments. Which type of lender offers very small loans to entrepreneurs who lack access to traditional banking? Microfinance providers offer very small loans to entrepreneurs who lack access to traditional banking services, especially in developing economies. What is the name for wealthy individuals who invest their own money into promising startups in exchange for equity? Business angels are wealthy individuals who invest their own money into promising startups in exchange for ownership shares or equity. Which type of finance is best for purchasing expensive equipment without a large upfront cost? Leasing is ideal for purchasing expensive equipment without a large upfront cost, as it spreads payments over time. How do microfinance institutions help support small-scale entrepreneurs? Microfinance providers help support small-scale entrepreneurs by offering tiny loans that can fund basic business needs, often without requiring collateral. Who combines mentorship and funding to help launch early-stage businesses? Business angels combine mentorship and funding to help launch early-stage businesses with high growth potential. Which type of cost does not change with the level of output? Fixed costs are expenses that do not change with the level of output, such as rent or salaries. What do we call expenses that rise as production increases? Variable costs are expenses that rise as production increases, like raw materials and packaging. What are costs that can be directly linked to a specific product or department? Direct costs are costs that can be directly linked to a specific product or department, such as labor for a particular project. What do we call costs that are not directly tied to a single product, like utilities or office supplies? Indirect costs, also known as overheads, are costs not directly tied to a single product, like utilities or office supplies. What is the total income a business earns from selling goods or services? Total revenue is the total income a business earns from selling its goods or services, calculated as price times quantity sold. What do we call the different ways a company earns income beyond just selling a product? Revenue streams are the different ways a company earns income, such as through advertising, subscriptions, or licensing. Which document shows a company's revenues, costs, and profits over a specific time period? The profit and loss account, also called the income statement, shows a company's revenues, costs, and profits over a specific time period. Which financial statement shows what a business owns and owes at a specific point in time? The balance sheet shows a business's assets, liabilities, and equity at a specific point in time. What financial document would an investor use to check a company's profitability? An investor would use the profit and loss account to assess a company's profitability by examining revenues and expenses. Which financial report helps a bank assess whether a business can repay a loan? A balance sheet helps a bank assess whether a business can repay a loan by showing its financial position. Who uses final accounts to decide whether to buy or invest in a business? Investors and potential shareholders use final accounts to decide whether to buy or invest in a business by reviewing its profitability and financial stability. Which type of asset lacks a physical form but still adds value to a business? Intangible assets are non-physical assets like brand reputation, patents, and goodwill that still add value to a business. What is the term for the reduction in value of a fixed asset over time? Depreciation is the reduction in value of a fixed asset over time due to wear and tear or obsolescence. Which depreciation method reduces the asset's value by the same amount each year? The straight-line method of depreciation reduces an asset's value by the same amount each year over its useful life. Which method calculates depreciation based on how much the asset is actually used? The units of production method calculates depreciation based on how much the asset is used, such as hours run or units produced. Which ratio shows how much profit is made from sales before expenses are subtracted? Gross profit margin measures how much profit a business makes from sales before subtracting operating expenses. Which ratio shows the percentage of revenue that becomes net profit after all expenses? Profit margin shows the percentage of revenue that remains as net profit after all operating costs and expenses. Which ratio tells us how efficiently a business is using its capital to generate profit? Return on capital employed, ROCE, shows how efficiently a business uses its capital to generate profit. Which ratio shows if a business can pay its short-term debts using its current assets? The current ratio indicates if a business can meet short-term liabilities with its current assets. What does the acid test ratio tell you that the current ratio might not? The acid test ratio, or quick ratio, shows if a business can pay short-term debts without relying on inventory. Which ratio shows how quickly a business sells its inventory? Stock turnover measures how many times a business sells and replaces its inventory over a period. What does the debtor days ratio tell us? Debtor days shows the average number of days it takes a business to collect payment from its customers. Which ratio tracks how long a business takes to pay its suppliers? Creditor days tells us the average number of days a business takes to pay its suppliers. What does the gearing ratio measure? The gearing ratio measures the proportion of a business's capital that comes from long-term debt compared to equity. Why is a high gearing ratio potentially risky? A high gearing ratio means the business relies heavily on debt, which increases financial risk, especially if profits fall. What's the difference between profit and cash flow? Profit is the money left after all expenses are paid, while cash flow refers to the actual movement of money in and out of the business. What is working capital? Working capital is the difference between a business's current assets and current liabilities, showing its short-term financial health. Why is liquidity important for a business? Liquidity reflects a business's ability to pay its short-term debts, which is essential to avoid insolvency. What is a cash flow forecast? A cash flow forecast predicts the future inflows and outflows of cash, helping a business plan ahead and avoid cash shortages. How are investment, profit, and cash flow connected? Investment can lead to higher profits over time, but it often reduces cash flow in the short term, creating a need for balance. What's one strategy to deal with a cash flow problem? One strategy to solve cash flow problems is to delay payments to suppliers or speed up the collection of receivables. What is the payback period method in investment appraisal? The payback period measures how long it takes for an investment to generate enough cash to recover its initial cost. Why might a business use the payback period method? The payback period is simple to calculate and useful when a business wants to recover its investment quickly. What is the average rate of return, arranged by? The average rate of return, arranged by, compares the average annual profit of an investment to the original cost, expressed as a percentage. Why is arranged by useful in decision-making? ARR helps compare the profitability of different investments over time, making it easier to choose between them. What does NPV stand for, and what does it measure? NPV, net present value, measures the present value of future cash inflows minus the cost of investment, accounting for the time value of money. How is NPV different from ARR or payback period? NPV considers the time value of money, while ARR and payback period do not, making it a more accurate method for long-term decisions. What's the difference between a cost center and a profit center? A cost center is a department that only incurs costs, while a profit center both generates revenue and incurs costs. Why do businesses use cost and profit centers? Using cost and profit centers helps managers monitor performance, control spending, and improve accountability within departments. What does it mean to construct a budget? To construct a budget means to plan future income and expenditure for a business or department over a specific period. What is a budget variance? A variance is the difference between the budgeted figure and the actual outcome, which can be favorable or unfavorable. Why are variances important in decision-making? Variances help identify areas where performance deviates from the plan, allowing for corrective action and better financial control. How can budgeting improve business performance? Budgeting sets financial targets, helps allocate resources efficiently, and provides a benchmark for evaluating performance.